Today, we're diving straight into 5 penny stocks under $5 that could be massively undervalued right now. No fluff, no hype, just hard numbers, financials, and what analysts are really saying about their growth potential. If you're looking for the next breakout opportunity, you'll want to stick around for every second of this list. Before we jump in, make sure you subscribe so you never miss our latest market updates, and let's aim for 500 likes on this video. It really helps push this research out to more smart investors like you. Here's why you should watch until the very end. We're going straight into the numbers, quarterly earnings reports, revenue growth, debt levels, analyst price targets, and why Wall Street might be missing the real value in these stocks. By the end, you'll have the exact information you need to decide if any of these deserve a spot on your watch list, or even in your portfolio. 1. NIO Incorporated, ticker, NIO. If you've been watching the EV space, you know NIO isn't just another electric vehicle manufacturer, it's one of China's most recognized EV brands. And right now, it's trading at just $4.91, a price point that feels shockingly low compared to its market potential. According to Investopedia, NIO recently broke out from a bullish wedge pattern, with a technical target of $11.45 if momentum continues. That's more than double the current price. But here's where it gets interesting. NIO isn't just making cars, it's building an ecosystem. Their battery swapping stations allow drivers to replace depleted batteries in minutes, removing one of the biggest pain points in EV adoption. Financially, the company's Q2 2025 report showed revenue growth of 12% year-over-year, despite a challenging macroeconomic climate in China. Gross margins improved from 1.5% to 3.1%, indicating better cost management. Analysts from Morgan Stanley maintain an overweight rating, projecting an average price target above $9. Why could NIO be undervalued? The market is pricing in slower EV demand in China, but NIO's move into Europe and the Middle East could be a game changer. They're already delivering vehicles in Norway and Germany, with expansion plans in the Netherlands and UAE. And here's the hook, NIO's battery-as-a-service model could turn into a recurring revenue stream, giving it a valuation boost that many investors aren't factoring in yet. So, if you're thinking about where the next Tesla-like rebound could come from, NIO might just be setting up for it. But hold on, because the next stock on our list is in a completely different industry and could have even bigger upside potential. 2. Gevo Incorporated, ticker, Gevo. While the world debates fossil fuels versus renewables, Gevo is quietly developing the next generation of clean fuel solutions, and it's doing so at just $1.25 per share. This isn't a meme stock gamble, it's a play on the global transition to net zero emissions. Gevo focuses on producing renewable fuels from corn and other biomass sources. The company's technology converts these feedstocks into low-carbon liquid hydrocarbons, which can replace petroleum-based fuels in cars, trucks, and even airplanes. According to Yahoo Finance, Gevo has already signed multi-year supply agreements worth over $2 billion, which could lock in revenue streams for the next decade. Their Q1 2025 financial report showed $5.6 million in revenue, up from $4.1 million last year, and the company holds over $400 million in cash reserves, a significant buffer while scaling production. The real kicker. Gevo's partnerships. They've secured deals with Delta Airlines and Chevron, giving them both credibility and demand for their sustainable aviation fuel, SAF. Analysts from Zacks believe Gevo could reach profitability by 2026 if production targets are met. Here's the hook, the market often ignores pre-profit renewable companies because they're too early. But remember Tesla in 2013? Investors who bought early in that cycle saw exponential returns. If global emissions regulations tighten, and they almost certainly will, companies like Gevo could see massive tailwinds from both government incentives and corporate demand for cleaner fuels. And speaking of growth potential, the next company is riding the streaming wave, and if they execute right, their upside could be just as big. 3. Fubo TV Incorporated, ticker, Fubo. If you think the streaming wars are over, think again, because Fubo TV is quietly carving out a niche that could make it one of the biggest comeback stories in the media space. Trading at just $3.59 per share, Fubo is a sports-first live TV streaming platform that's targeting cord cutters who want live games, interactive features, and betting integration, all in one place. According to Yahoo Finance, Fubo TV ended Q2 2025 with 1.45 million paid subscribers, a 7% year-over-year increase, and reported $320 million in quarterly revenue. Losses narrowed to 16 cents per share compared to 23 cents last year, signaling a move toward profitability. The company has also reduced its cash burn significantly, a huge plus for investors in the streaming sector. The real innovation, Fubo TV's integrated sports betting platform, which allows viewers to place wagers while watching games in real time. That's a feature Netflix, Disney+, and even Hulu can't match. Analysts at Wedbush Securities believe this unique positioning could lead to strong monetization opportunities, especially as more states legalize online sports betting. Here's the hook. The market is valuing Fubo like just another streaming service, but its sports-first strategy makes it less vulnerable to the content licensing wars that have crushed competitors. And with more sports leagues looking for direct-to-consumer partners, Fubo could be a prime acquisition target. If sports betting adoption accelerates and subscriber growth continues, this $3.59 stock could easily push back into the double digits over the next couple of years. But we're just getting started. The next company is a global super app with billions in transactions flowing through its platform. 4. Grab Holdings Limited, ticker, Grab. If you've traveled through Southeast Asia, you've probably used Grab without even thinking about it. But here's the surprising part. This ride-hailing, food delivery, and digital payments giant is trading under $5 despite processing billions of transactions every year. Grab isn't just Uber for Southeast Asia. It's a super app, meaning users can order food, pay bills, book rides, send packages, and even manage finances all in one place. According to Nasdaq.com, Grab's revenue in Q1 2025 surged 17.8% year-over-year to $615 million, driven by strong growth in both delivery and digital financial services. The company is now on track to achieve full-year profitability for the first time in 2025. Financially, Grab is cutting costs while expanding. Adjusted EBITDA improved by over 65% in the last quarter. That's a clear sign that management is laser-focused on sustainable growth rather than endless cash burn. Analysts from Goldman Sachs rate Grab a buy, with a 12-month target of $6.50, citing increasing market share and improved monetization per user. Here's the hook. Southeast Asia's middle class is exploding, and Grab is perfectly positioned to capture that spending. Imagine being able to buy into Uber, DoorDash, PayPal, and Venmo all rolled into one, and doing it for under $5 per share. If mobile payment adoption continues at its current pace, Grab's valuation could look extremely cheap in hindsight. But our last pick today taps into an entirely different asset, gold, and has been posting numbers that the market hasn't fully priced in yet. 5. IAMGOLD Corporation, ticker, IAG. Gold has always been the go-to asset in uncertain markets, and IAMGOLD is one of the smaller producers that could benefit disproportionately from rising metal prices. According to Nasdaq.com, IAMGOLD's Q1 2025 results were impressive. Revenue surged 49.8% year-over-year to $338 million, while earnings per share hit 11 cents, beating analyst estimates by 37%. The company also reported over $800 million in liquidity, giving it financial strength to weather commodity price swings. What makes IAG especially interesting is its growth profile. The Coté mine, which began production in early 2025, is projected to deliver over 365,000 ounces of gold annually at competitive production costs. That could significantly boost both cash flow and profitability over the next several years. Analysts from BMO Capital Markets have a price target of $6, noting that the market is undervaluing IAG's future production potential. Here's the hook. Gold prices have been climbing in response to inflation fears and geopolitical tensions, and IAG offers a leveraged play on that trend. Unlike large-cap miners, smaller producers like IAG can see outsized stock gains when gold rallies. If gold breaks above $2,300 per ounce and IAG executes its production ramp as planned, today's sub-$5 share price could be a bargain.